A hedge fund is essentially an unregulated pool of capital. They're similar to mutual funds in that a group of investors pool their money and hire a fund manager to invest that money, but they're different in that they can employ different strategies in order to invest that money. Unlike mutual funds, hedge funds have an unlimited ability to go long short, perhaps use leverage, and also, unlike mutual funds, they do not have to disclose their investments. Someone would invest in a hedge fund as a way to generate uncorrelated returns to other investments they might hold in their portfolio. Hedge funds are designed to deliver positive investment returns independent of the types of returns you would get while investing in a stock fund like a mutual fund or perhaps the bond market.
So there's a number of different hedge fund strategies out there, but let's go with the bellwether, which is equity long short. Equity long short can be implemented in a number of different ways, but the basics of it are, given the name, is that you're going to go long a stock to hope it increases in value, and you're going to short a stock that you believe will decrease in value. The reasons for it going up in value or down in value can be up to the portfolio manager, and there are many. It can be from macro factors down to micro company specific factors and drivers. Long short equity can be levered, or it can be invested at a very low leverage point, and geographically diverse. So it could be country specific, it could be industry specific, it could be global in nature.
Hedge fund strategies are generally categorized under four major headings. Those would be global macro, which is exactly as it sounds. You're thinking about how the macro environment will affect the investments that you have in the underlying portfolio. Directional, which embody things like long-short equity. Geographic, where maybe you're investing in emerging markets, or perhaps sector-specific, where you're investing perhaps in the technology sector. Other strategies include event-driven, which is essentially where the fund manager is looking at very specific corporate events, legal events, that will drive value in the underlying stocks. And then there's also relative value, which is exactly as it sounds. You're looking for opportunities where value has diverged, and you're looking for them to revert to a mean. A fund may employ a single strategy or multiple strategies for flexibility, risk management, or perhaps diversification. The important thing to understand about liquidity for a hedge fund is they have very specific parameters where one can start to redeem, and it's different from a mutual fund where often you'll have daily liquidity, or a private equity fund where you'll have multi-year lockup of your capital. So what that means is you may have a one-year lockup where you can't trade out of the hedge fund, and then over the course of call it 1 year, you can start to redeem a portion of your investment until you have completely redeemed your investment.
So fees can vary just as much as strategies. We've seen them anywhere from a flat management fee all the way to 5% management fee and a performance fee of 50%. So they absolutely can range the gamut, and that's really a supply and demand factor. Industry standard is a 2% management fee and a 20% performance fee. And when I say performance fee, other times referred to as carry, that is really the percentage of profits that are made on the underlying investments that the manager gets to keep. So it's their incentive to do well and to manage risk. One other facet of hedge funds and how fees are structured is the high water mark. So basically, this is something that's pretty standard in most hedge funds, whereby if you are down in one particular year, as the hedge fund starts to make money again, they will not collect an incentive fee until that money that was lost in either the previous year or previous quarter has been made back. So at Mercury Capital, we work with investors across the world, from the top endowments at the top colleges out there to pensions and even sovereign wealth plans and some of the best and most well-known families in the world. The typical theme that we see across diligence of hedge funds from these institutional investors can really be broken down into three main points. The first one, it's all about the people. The people that you're investing with. You're typically with them for a minimum of a month to up to 3 years. And they're also representing the institution to a broad extent, and we call that headline risk. So you really want to get to know the people that you're investing with. Secondly, one of the areas of diligence that we'll tend to focus on and that we've seen prevalent across institutional investors has to do with alignment of interests. Does the manager have a majority of their liquid net worth invested in the fund? Are they going to, increase their return and lose money alongside of you, or do they have interests elsewhere? That's always a very important theme when institutional investors are doing the underlying diligence with hedge funds. And thirdly, obviously, it's going to come down to performance. It's why we're investing. It's why we're here. The most important thing is sustainability of return. Can they do that process over and over again? So what does that look like? And it's a defined, well-tuned, well-oiled performance where they've had success in the past.